Welcome to Bulls, Bears, and Pigs podcast, presented by SizeTrade.com. Simplifying technicals, fundamentals, and market psychology for one goal and one goal only, to help you make money in all market conditions.
Good morning, Size Traders. This is Amos here with Gary, head trader at SizeTrade. Gary, thanks for being with us today.
Good morning, Amos. How you doing?
Good. Gary, we had a question come in from one of our users, Chris. He trades a lot of different instruments, but he wanted to ask you specifically about stocks. So his question was the following. Gary, I day trade futures, but I also hold some stocks longer term. On CNBC and on your podcast, I've heard that the markets are expensive here. I was hoping you could explain what metrics you look at to evaluate if stocks are expensive or cheap.
Okay. Yeah, sure. We don't really talk much about this, so it's a good question. When you hear it on TV that stocks are historically expensive, they're typically talking about PE ratios, which is just very simple, price divided by earnings per share. So when you look at historically, every sector has a different PE ratio, but also the overall market has a historical PE ratio. People like to say it's in the mid-teens, 16, 17, and when you're trading at 18 times earnings, and then it gets a little bit even more complicated because you have estimated PE, which is the future PE, which we don't know for sure. So it's based on analyst estimates of what the company will earn versus actual PE, which is last year's PE, which is typically, if you do that, then the PE ratio goes higher because typically stocks or companies increase their earnings year over year. So again, if you look at backwards looking data and last year's PE ratio, typically it's higher. If you look at forward looking P ratio is typically lower. And then some people like to go out, not this year, but even next year, which I think is foolish because nobody knows what anybody's going to do next year. Nobody knows what the economy is going to do. So I personally, if I do look at the P ratio, I try to look at the P ratio of what they're expecting this year. I also do look at last year's P ratio. So they're expecting a big growth rate. I need to figure out why that growth rate and see if it's reasonable, if something that I agree with. My favorite metrics that I look at actually is the PEG, which is price divided by earnings divided by growth. And the reason I like to look at that is it makes it a little bit more simpler for me because just because historically a sector or a company has a historic PE ratio doesn't necessarily mean that the environment that we're in today is conducive to that. So just to give you an example, it used to be that consumer staples would trade at a 10 multiple. And the reason why is because they had relatively low earnings growth. They were seen as safe companies. Let's take Procter & Gamble as an example. And then all of a sudden in the 2000s, you saw the devaluation of the dollar. Dollar started becoming weaker, particularly against currencies, not only the euro, but also against the Brazilian real, pesos in Latin America, different currencies all around the world, the Australian dollar, and so on. So Procter & Gamble, which had 60% of its earnings coming from overseas, all of a sudden their growth rate started to climb up and wasn't growing at the traditional 7% every year, 6% every year. All of a sudden, because of the earnings conversion back to dollars, was growing in the low teens. So in this case, I don't think that the historical P ratio for a company like that is accurate when we're looking at the previous 20 years in that case when the dollar was very stable to strong all the time. So in environments that change, it's good to look at the actual growth rate of each individual company.
So Gary,
sector.
if I could just ask, when you mean growth rate, you're talking about year to date growth rate, right? It's not future growth rate?
It's year over year growth rate. So I look at, you could look at the previous year's growth rate to get an example, but I also look at the estimates of where, analysts are not going to hit the estimate 100% of the time, but they'll kind of be in the ballpark. So sometimes, what I do personally, is I look at last year's growth rate and I say year over year growth rate. So let's take, we're in 2017. So let's take 2016. So I look at a growth rate of a company and say, okay, between 2015 and 2016, this company increased their EPS earnings per share by 10%. Then what I do is I break that down and say, where did that growth rate come from? So I look into the businesses and I see, okay, well, 6% of it came from buybacks. 1% came from currency, positive or negative. So if the dollar is strong, typically that's a negative earnings catalyst for them because they're selling in euros or they're selling in yen. And then when they're converting back to the dollar, they're making less dollars for it. So I take all of it into account and I say, okay, I see. So their growth rate came, some of it from buybacks, some of it was a negative from currency because the dollar was strong. Organically, they grew 3 or 4% just because they're increasing market share, they're increasing volumes, they've got into new businesses. Maybe they did a purchase of a company. So I take a look at all of that in one and say, okay, I make sense. The growth rate to me makes sense. So now let's look forward, and this is what analysts are expecting. Analysts are expecting another 7% of growth. And then I kind of take a look at it and say, okay, are we conducive to that? Well, let's look at their buyback program. Is their buyback program still large? Do we expect them to renew it when it's up, if it's up anytime soon?
Do you wait? Do you wait the? Let's say you gave the example that a company is growing at 10% and 6% buyback, 3%, let's say organically, another 1% in currency. Do you weight those differently in your assessment?
So I don't weigh them differently, but what I do is I want to make sure that they're going to continue. That's, to me, the most important part of future growth rate because I feel like analysts are lazy a lot of times and they don't look, they just kind of just, okay, well, they're growing at 7%, so we'll give them the courtesy and say, they'll grow at 7%, and then we'll say that, oh, we think that the market is bullish, oh, and we think the economy is doing better, so we'll give them an extra 1 or 2%, or vice versa, the economy is doing poorly, so we'll take away 1%.
The reason the
So what
reason
I
I ask is because we've talked a lot about buybacks and the negative effects long term, I suppose, on buybacks. And let's say you had two companies growing at 10%, where 60-70% of one company was due to buybacks, and the other company was only 20% due to buybacks, and the rest was organic growth. Would you weight that differently? I guess that was my question.
Yeah, for sure, I would. Well, there's two things. First of all, you have to ask yourself what's your time frame. So if you're looking out 10 years, 15 years, which I don't think many people are these days because it's so easy to buy and sell stock and so cheap these days with commission rates where they are. So I don't think people are worried about the very long-term negative effects of buybacks that you're putting debt on the balance sheets. And as long as the market's not concerned about that, you're okay. I think if eventually the market will start looking at balance sheets and saying, okay, this company has a good balance sheet, this company has a bad balance sheet, and so on. At that point, you have to be a little bit more selective because you're going to see outperformance of companies that have good balance sheets. I think that's going to come closer to the last phase or the beginning phases of a recession because that's when people care. Because when times are good, you're always going to have money flowing into the economy, into stocks. Companies are always going to be able to refinance debt. But as we enter or the last inning of the bull market and start looking at a recession, that's where companies are going to say, okay, not companies, sorry, investors are going to say, how are these companies going to be able to go forwards and raise money in bad times? It's easy to raise money in good times. So that's part of it. But also, what I try to look at is if a company has a small buyback, and we're in a time where buybacks are very popular, maybe that would be very good. And you can't find many companies that have small buybacks that have the ability to do it. But if you can, you could say, oh, well, maybe activists are going to come into this company. And if an activist comes into this company, then they can persuade the company to do a bigger buyback and thus increase earnings. So if you have two companies that are growing 10% and one is relying heavily on buybacks and one isn't, then most likely the one who's relying heavily on buybacks probably doesn't have much room to grow to get more juice out of the buybacks to increase their EPS, as opposed to the company that has a good balance sheet, doesn't have very big buybacks, they have still ability to juice it. So if you're comparing apples to apples, where they're 10% and 10%, and one company has the potential to boost earnings by 2-3% by doing a big buyback, that's obviously a positive, and the market will reward it with a higher P ratio, knowing that that's a possibility eventually to do. Like Apple, for many years, the problem is with Apple, it's such a large company, and activists have tried and failed to motivate Tim Cook to do some buybacks or buying out companies. But typically it was seen that Apple had all this money overseas and had the ability that if they bring it back when they repatriate, like if Donald Trump's able to pass something to bring back the cash, they're going to push a lot of that money into buybacks, which will increase their EPS. So actually, if you see, the iPhone 7 hasn't done really that well. It's the first time I believe they had negative year-over-year iPhone sales and iPad sales are down. So a lot of that is like, wow, Apple should be doing poorly, but you see Apple breaking out to a new high, and a lot of that has to do with the hope that repatriation will allow them to buy back a big portion of their stock. I think they have $100 billion overseas that they'll be able to bring back if uh, Trump gives them a favorable tax rate. So getting back to the initial question about what I look at, what's expensive or not, I look at the PEG. And basically, so what I do is there's two ways of looking at the overall stock market and economy. There's top down or bottom up. I personally prefer for top down, which means I look at the overall economy, the world economy, and ask myself, okay, are there tailwinds or headwinds? Are we conducive to growth, or is it going to be a tough environment to grow? Right now, in my opinion, we've been in a very tough time to grow. World GDPs are not anything to write home about. If you take out like China and you look at more of the developed countries like U.S. and EU, they're growing around 2%, which is really nothing great. It's not bad, but it's not good. So what I do is I take a look at that and I say, okay, so I know that if we have higher growth rate around the world, particularly U.S., Europe, China, then I understand that that will positively affect companies' earnings because that growth rate will translate into sales if the company does business in those countries. So what I do first is I kind of look at the whole world and say, okay, the world is right now we're stabilized. U.S. looks like maybe growth rate could pick up. The reason why is because Trump is going to pass some pro-growth stuff. Europe looks like it's finally steadied, and now the growth is picking up. One of the reasons why is because the euro's cheap, so their manufacturing is increasing. China, on the other hand, is slowing down. Considering China has its own structural problems, they're trying to pump stimulus because they can't afford that the Chinese economy slows down. Japan is at zero growth. I don't see anything very positive coming out of it. I don't see anything negative coming out of it. The rest of the world, you have your hot spots and your weak spots. Anything to do with commodities right now is obviously going to be weak with oil prices down in the 50s. You're going to see some weakness in Latin America, which a lot of these countries rely on oil as the main export. You're going to see continued weakness out of Russia, which is a huge exporter of oil. You're going to see continued weakness in the Middle East. But again, the world consists basically of the U.S., Europe, China. They make up the biggest portion of world growth. So we're seeing potential for U.S. growth from pro-growth policies from President Trump. You're seeing some great tailwinds for Europe with the weak euro. So I go from there. I deconstruct from there, and I say, okay, well now let's take a look at each individual country, which I mentioned. U.S. What are the prospects for U.S.? What's the prospects for euro, and so on. And again, I think Asia is going to muddle through. Europe, as long as the euro could stay weak, is going to do well. U.S., as long as we could get some pro-growth agenda through, is going to do well. And then I start looking at the actual company. Then I say, okay, well, then let's take Apple, just because we mentioned it. Okay, where does Apple sell its stuff? Where is the majority of Apple's iPhone? Where's the majority of the margins coming from? Okay, it comes from the iPhone. Now, okay, where do they sell the iPhone? Okay, they sell a lot in the US, they sell a lot in China, Asia, they sell a lot in Europe. Okay, so we see some strength in those countries. Okay, great. So geopolitically and growth-wise, Apple is in an okay situation. You don't see any shrinking in any specific market that they really need. Now you go to the next step and you say, okay, well, what's going to affect China, right? So now we see that maybe if there's a trade war, that will obviously negatively affect Apple. Okay, that's a negative. In Europe, I don't see personally any negatives towards the iPhone. In America, I don't see any negatives. Okay, so China. So now we have to deconstruct it again and say, okay, what percentage of earnings come from China, and what's the probability of them being under pressure due to a trade war with the U.S.? And you give it a certain percentage that you believe might happen. In my personal opinion, I don't think Donald Trump is going to start a trade war with China, or at least not anytime soon. So in my opinion, there might be some rhetoric, so it might affect their sales, but not in a big major way. So now you have to kind of continue to deconstruct it to the sector and say, okay, well, how is the actual mobile phone business doing? So in this case, you have to take a look and say, okay, how is Apple doing versus some of the homegrown Chinese companies versus Samsung. So Samsung had its issues because the Note blew up. It's not very popular anymore. So that's easy. But they do have competition from lower end phones that give you almost the same exact performance as an iPhone for, I don't know, a third of the price, something in that vicinity. So then you have to ask yourself, what is that? How is that going to negatively affect their earnings? In the U.S., we have a bigger issue, in my opinion, and this is a negative for Apple, and we're speaking specifically about one company here, is that we no longer have contracts. So what we used to happen is the mobile operators, AT&T, T-Mobile, Sprint, Verizon, used to have 2-year contracts, and to force people or to let them sign up for 2 years, they'd give you a very significant rebate on the phone. So they'd say a $700 iPhone, if you sign a 2-year contract, we'll give it to you for $100. So you had this upgrade cycle in the US of every 2 years you'd come in and trade up your iPhone, not because necessarily your iPhone was bad or you wanted a new iPhone, but just they were giving it away at such a subsidized price, you might as well take advantage of that price. Otherwise, you just signed the 2-year contract because you don't have a choice and you get nothing for it. So this was obviously a really big positive catalyst for Apple because every 2 years they knew they were getting an upgrade cycle. That's why they would come out with the iPhone 6 and then the 6S is because the people who signed up for the 2-year contract when the iPhone 5 came out will switch to the 6. The people who signed up to the 2-year contract for the 5S would switch to the 6S. And this was a really big tailwind behind Apple's earnings and the ability for Apple to sell iPhones, which is a $700 phone, to basically the majority of people. T-Mobile a few years ago changed that equation and said, we're not going to do any more contracts. And what we're going to do is we're going to allow you to finance your phone. So we're going to do a very low priced monthly fee for your service. And then if you want a phone, we'll finance it over 2 years. So you'll end up paying what you were paying before with a contract. But after the 2 years, if you want to keep your phone, your bill will go down a decent amount. So what we're seeing now with that is that people are taking care of their phones much better because they know that every 2 years they're not going to get subsidized anymore. And they no longer upgrade the way they used to because they don't want to pay the extra $20, $30 a month or $40 a month that it'll cost to finance your phone. So they're happy holding on to their iPhone 6 for another year or two longer than they normally would. Because they're not subsidized anymore.
Gary, let me ask you something though. You're going into real depth about how you would look at and how you would analyze it from like a top-down way. But eventually, in order to come up with some sort of evaluation, we talked about PE, we talked about PEG, but what you're talking about, how do you put numbers to that? How do you put numbers to the effect of, okay, now I think China is going to do X, Y, Z, and when it comes down to it, I think Trump's policy is going to affect it like so. But how do you actually come up with a number where, okay, I think this is going to decrease the price or this is going to increase the price?
Right. So yeah, so I'm basically there right now, which is once you go through from top down, you get an understanding of what you think about the business. So you say, okay, Apple has, in this case, some headwinds, some tailwinds. Then what I look at again is the PEG. So what I do is I say when times are really bad, like 2009 bad, I'm willing to only pay 1 times that growth rate. So if the growth rate is 10% year over year, I'm only going to be willing to pay a 10 PE ratio on it. So anytime that the stock is trading at a higher PE ratio than 10, even though historically I know it's trades in the 20s and so on, I'm now personally willing to pay more than 1 times that growth. That very rarely happens. That's obviously an extreme. And the other side of the extreme, when everything is lined up and you're having growth everywhere and it's the sector is awesome and there's a lot of tailwinds behind it pushing it forward, I'd be willing to pay by maximum 2 times growth rate. So if a company is growing at 10%, I'd be willing to pay 20%. Sometimes you end up missing some great moves like Facebook and Amazon, companies that don't have necessarily great growth rates, but people are willing to pay on other metrics. So you have to sometimes take a look at other metrics to decide how to value each individual company. But I'm taking the majority of companies, this is how I value them. So based on everything that the checklist that I do, which is start with world growth. Okay, world growth is doing on a scale of 0 to 10 a little bit better than average. So let's take it as 6 or 7 this year, if we could get some of the stuff through. So then what I do is I start at 1.5 times growth rate if everything is okay. So if the world growth rate is a little better, I'd be willing to pay a little bit higher for overall stock. So maybe a 1.7 times earnings growth rate. So if it's growing at 10%, what I'm willing to do is I'm willing to pay 1.7, so I'm willing to pay 17 times earnings. I feel like that's fair value for me for any given stock or sector or overall market. Then I start taking out stuff as well. So in this case, China is slowing down a bit, so that's obviously not great for Apple. The U.S., like I spoke about, might have sorry, some caps of growth rate because of the way that they realign the contracts. So that's a negative. Europe is growing well, so that's okay. So maybe now for Apple, because I think that world growth is going to be okay, but the actual mobile industry might have some issues, and China might have some issues. I might lower that back down to 1.5. So 1.5, and let's say again, I don't know Apple's growth rate off the top of my head. Let's say it's 10%. So 10% times 1.5, so 15. So I'd be willing to pay 15 times earnings. I think that's a fair value. So if it gets cheaper than 15, I think it's a great buy. If it's a lot more than 15, I think it's not necessarily the best buy. And if it gets outrageously expensive, then you have to start looking at it as a short and understanding why people are paying such a high multiple for a company with not the best growth rate. Usually there's a reason. So what ends up happening is you kind of have to take a look at an overall market, and that's what the question was about. Like CNBC and I speak about the whole market, is what's going on in the overall market? What's the growth rate? So we're expecting or we're anticipating 10% roughly growth rate in earnings per share for the S&P 500, and we're trading around 18 times those numbers. So now you have to ask yourself on a for P ratio, is it worth trading 1.8 times growth rate? And in my opinion, that's a bit stretched on the valuation, not just historically, but also with what I see. There are positives to the US growth rate, there are positives to European growth rates, but I think there are some negatives to the Asian growth rate. There are some negatives to some of the oil producing countries. So I personally think that we should be trading closer to around 16 to 17 times earnings. So we're not outrageously priced, but I just think that the market is looking very optimistically at a lot of stuff, and they're not looking at any of the negative counter sides to that, such as stagflation, if we do have a trade war. And again, the probability of those things happening are small, but you still have to price it into as a possibility of it happening. So in my opinion, I believe that the market is trading a bit expensive here due to the fact that I don't think that we're going to hit that growth rate of 10%. I think those numbers are going to go down a bit, especially with the dollar being so strong. And even though we're really positive on the U.S. with the pro-growth agenda, we're positive on Euro with the Euro region with the Euro being weak, and we're hoping that Asia will find its footing this year. I just think 1.8 times growth rate is a bit much, considering that growth rate is going to probably come down anyway. So you might end up trading at that high end of 2 times growth rate by the end of the year if earnings come down a bit and the stock market continues to stay at these elevated levels. You might get to that extreme level where you're not pricing in any negatives. You're only looking at the positives, and everything is Goldilocks. And historically, that's when you get into trouble. You got into trouble. That's typically what happened in 2007. It's typically what happened in 99. Actually, in 1999, you know, depending on which sector, some of the matrices were really off the charts, specifically in technology. But even outside of technology, overall, the market was way too optimistic, and we began trading as earnings started slowing down, and the market didn't continue to extend to the upside. What you ended up seeing is that those PEG ratios were coming to 2. And anytime it gets to 2, it has to be a perfect setup for it to be able to withstand that without a major pullback. And obviously it didn't. Obviously the tech bubble burst. Obviously the housing market burst in 2007. And we're getting close to that level that if earnings come down just a bit, we might be pumping up against that 2 level again. And that's a scary level to be buying stocks longer term.
Well, Gary, as the saying goes, the markets never lie until they're wrong, right?
Exactly, 100%. You know, one of the first sayings that I learned, and I love this saying, is the market is always right. Doesn't matter what you think. It doesn't matter how smart you are. Doesn't matter how sure you are about the outcome. At the end of the day, whatever the price action in the stock market does, that was the right thing to do. And if you look back at it and say, well, the market, looked at this and they were wrong, No, that doesn't matter. Market's always right because that's the price action and that's what we have to live with. Eventually, the market might realize and see it your way, but in the near term, if you're wrong, you're wrong. There's no two ways about it.
Gary, thank you so much for your time. Again, Size Traders, subscribe SizeTrade podcast. Until next time, this is Amos with Gary, heads trader at SizeTrade. Gary, thanks so much.
Thanks a lot.